Now we will calculate the cost of the spread, or an example is in front of you. What is the formula to calculate the cost of the Euro USD spread at this time? We need to multiply the spread's pip size by the lot size, as we have learned. For example, we are using a mini lot of 0.1, which amounts to 10,000 units. We will multiply that by the per pip value. Now, since the dollar value of Euro USD is $1, we will multiply it by $1. So when we multiply it, our spread cost will come out to be $1.4. What is our lot size? It is 0.1. If we change this lot size to 1.1 standard lot size, then this cost will become $11. If we make it 0.0 lot, then our cost will become 0.1. Understand that the larger our lot size, the more our cost will increase. If I open 5 positions of 5 mini and 0.1 on Euro USD, where the spread was pip, then the cost of my 5 rates came to $7, meaning I will have to pay a cost of $7. Orders went into profit or loss. That's why our broker friends focus you on making as many trades as possible. You make $10, made $20. They have already made more money through the spread from you, even if the broker is an A book. If it's a B book, they just want you to lose your money. So now, whenever you trade, you are adding the spread to your profit wars. Brokers automatically do it for you. When you open a position, that gap is included. Now, what is the bid and ask price? The bid price is very simple. The price at which the market is ready to buy and at which you are ready to sell. The ask price at which the market is ready to sell this currency and you are ready to buy. Now, the example of Euro USD is 1.10252. This is its bid price, and 1.10264. This is its ask price. Now, this difference is the bid and ask price, meaning the market was ready to buy at this price in the bid, because when you are selling, someone has to buy, and when you are buying, someone has to sell.